If you do the proper planning and follow these steps, getting a mortgage will be a simple, hassle-free experience. Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. I'm Andrew Shear, and if you're looking to purchase a home with a mortgage in the near future, you're in the right place. Today I'm going to help you understand how to prepare and take the first steps in a process that will end with you in your new home. Before I get started, do me a favor and hit that like button. And if you're new here, hit that subscribe button too. You're about to learn something new about money. If you've decided that you'd like to become a homeowner, especially for the first time, chances are you're going to need a mortgage. Now, the idea of a mortgage might seem a little bit scary, but in reality, it's just a loan from a bank that's secured by your home. And if you've never heard that term secured before, it just means that if you don't pay it back, the bank will take your home and sell it to someone else to recoup the money. But don't worry, as long as you make your monthly payments, you're going to be just fine. Before you even talk to a mortgage or real estate professional, there are a few steps you should take to get yourself ready. You should maximize your credit score, minimize your debt to income ratio, calculate how much you'll be able to comfortably afford, and save a down payment. Let's go over each of those one by one so you can take action. Step 1 is to maximize your credit score. This is what mortgage lenders are going to look at first when you submit your application. The higher your credit score, the more trustworthy you appear as a borrower. And the more trustworthy you appear as a borrower, the better terms you'll get for your mortgage. When I say terms, I'm mostly talking about the interest rate you're given. Improving your credit score, if you need to, can be a long process. So the earlier you start, the better. But if you're short on time, there are a few tricks you can use to give you a quick boost. I've made 2 videos that can help you with this exact topic, and I'll leave links down below. Step 2 is to minimize your debt to income ratio. This is what mortgage lenders are going to look at to determine how much they can lend you. To get your debt to income ratio, you take your monthly recurring debt payments, credit cards, student loans, car loans, etc., and divide it by your monthly income before taxes get taken out. So for a quick example, let's say I have a monthly credit card payment due for $100, a student loan for $250, and a car payment for $450. And let's say I make $60,000 per year. So I divide that by 12 to get my monthly income of $5,000. First, I'll add up all my debt payments, $100 plus $250 plus $450, and I get $800. Then I divide $800 by my income, $5,000. The result is 0.16 or 16%. That's my debt to income ratio. When you add a mortgage payment to the mix, you're going to need to stay below 0.45 or 45%. So the lower your debt to income ratio, the more you'll be able to afford in the eyes of your lender, and the more they'll be willing to let you borrow. Step 3 is to calculate how much you can comfortably afford. Your housing payment is most likely going to be your biggest expense every month, and that's not even counting property taxes, homeowners insurance, and HOA fees. It's important that you don't end up with a monthly housing payment that's too high. If you buy more house than you can comfortably afford, you'll end up having to cut back on vacations, college funds, and retirement savings. You don't want that. There are a ton of different methods for determining how much you can afford to spend on a home. If you want my take on it, I made an extremely detailed video that takes you through the calculations, and I'll leave a link down below with the others. And finally, step 4 is to save a down payment. Your down payment is what you're going to pay up front when you purchase your home. The more you have saved for a down payment, the less you need to borrow for your mortgage. It's pretty simple. If you put down less than 20% for a down payment, you'll need to pay extra every month for something called private mortgage insurance, or PMI. Some people will tell you that PMI is a complete waste of money and that you should never buy a home without a 20% down payment. But I know that's not realistic for everyone. So I asked California-based mortgage broker Matt Gouget, also known as Matt the Mortgage Guy, for his take.
If you're in California, the thought of saving $100,000 plus to be able to put 20% down, for some people who are starting off in their careers, they would save for 15 years. I mean, they would never buy. And imagine somebody who's been saving their money since 2005 because they wanted to buy. They could have bought something in 2005 for half of what they'd pay now, and they'd be long out of mortgage insurance by now if they would have bought way back then, and they'd be halfway towards paying their loan off in full. So I'm a big fan of PMI because it helps people get into a home. I'm not saying that you shouldn't save for a down payment and putting more down is going to help you on a monthly basis and whatnot, but it's definitely not necessary to put 20% down.
Now that you're ready to get a mortgage, it's time for you to shop around for one. So next, let's talk about where you should be shopping for your mortgage, what the mortgage pre-approval process is, and why the interest rates you see advertised might be different than what you end up with. Step 1 is determining where you're going to be looking for your mortgage. You can go to a direct lender, like a bank or a credit union, and speak with a loan officer. Or you can go to a mortgage broker who will act as a liaison between you and a lender. A mortgage broker will take down your info and shop around to find the best possible option for you. And they'll be able to provide valuable advice throughout the mortgage process that you just won't get with a national bank or an online lender like Rocket Mortgage.
When we're going through the pre-approval process like I talked about, and I'm advising somebody, here's exactly what it looks like at 425 and 450, and just for your knowledge, let's look at 5% versus 10%. And I know, because I've got all their information, if you've got $55,000 in total liquid assets, I'm not going to advise you to put $50,000 of that towards a down payment of a home. I'm going to say, let's look at 5% down. Let's keep $25,000 in the bank, emergency fund, rainy day. Inevitably, you're going to want to upgrade a few things to this house. And based on what you've told me and based on your budget, it's a comfortable monthly payment. That's the type of advising I just don't think you're going to get with one of those big companies.
If it's your first time buying a home, a mortgage broker like Matt can make the whole process a lot easier and less time consuming. But like with anything else, that convenience comes at a little bit of a cost. You might be able to save a few bucks by cutting out the middleman and working directly with your lender. But you should expect to spend more time shopping around and comparing different options. If you choose this route, make sure you avoid the big banks and stick to your local bank or credit union. Step 2 is getting pre-approved for a mortgage. This is where you'll start to get an idea of what your mortgage will look like. You'll fill out a primary application and submit some documents like bank statements, pay stubs, and tax returns. Your mortgage broker or direct lender will check your credit. They'll do some work behind the scenes, and then they'll let you know the amount you'll be able to borrow, the interest rate you'll be given, and what your monthly payments will be.
A pre-approval is for your peace of mind. A lot of times consumers, I think, are hesitant. They feel like it's a sale of some sort where it's like, you got to call the loan officer, you got to get pre-approved, and they think a loan officer is going to call them and try to sell them something. You talk to me or talk to any loan officer that's good at their job, I'm trying to give you as much value as I can possibly give you. By getting pre-approved with me, you're not signing any contracts. You don't have to use us, but in that pre-approval process, you're going to learn a lot of things specific to your situation. How much do you qualify for? What the monthly payment's going to look like? How much the total cash to close is? What 3% down versus 5% down looks like? All that information, the more involved you are and the more you provide when you're getting pre-approved, the better and more accurate that pre-approval is for you. And I tell people, you're 3 months, 6 months, a year away from buying a house, it's still a good idea. You'll know exactly where you're at. If you're not ready, you'll know what direction you want to head or things you want to do. So the pre-approval is always a good idea, in my opinion. And people who are hesitant to do it, I understand I don't want to pull my credit, or I'm not quite ready, or I don't want to gather all this stuff. 10 or 15 minutes to fill out an online application and upload some documents is a small price to pay to have a really accurate snapshot of exactly what it's going to look like to buy a house.
Step 3 is taking a closer look at the interest rate. We've all seen low interest rates advertised online or on TV, but it's likely you'll have to pay extra to get those rates. You might be thinking, what? Pay for an interest rate? Here's how it works. Your interest rate will depend on a number of factors, including your credit score, your down payment amount, your income, your total debt load, and more. But before you ultimately sign on the dotted line, you have the opportunity to fine-tune your rate. You can do this by using things called points and lender credits. With lender credits, you accept a higher interest rate in exchange for lower closing costs up front. With points, you pay an extra fee up front in exchange for a lower interest rate. So are the lower interest rates worth the cost of points?
Most of the time, the math doesn't make sense. You're not gonna pay $7,500 for a 2.5% rate versus zero for a 2.875 when it's only saving you $37 a month. Because you'll take that $7,500, divide it by 37 and realize, well, it's gonna take me 200 months to break even. There's no way anybody who knows what they're doing would advise that, but by advertising 2.5%, 30-year fixed, or 2.25%, or 199, whatever it is, they know they're going to get you to click. They know they're going to get you to call. And trust me, as a mortgage pro, I get people all the time like, "Are you guys got 2.25, right? I saw that online. I saw that on a Super Bowl ad or whatever it is." The rate exists. It's just not the best choice. You're looking for not the best rate per se. You're looking for the best combination of rate and cost.
If you're planning to keep your mortgage around for the full term and you've got some extra cash up front, points might be a good idea. On the other hand, if you're planning to pay off your mortgage way early, lender credits might be a good idea. It all depends on your specific situation and your plan for paying your mortgage off. So make a plan and do the math. You might be able to save yourself a lot of money in the long run. It's finally time to go shopping for a home. If you've done the work ahead of time, you can be confident you aren't wasting your time looking at homes you can't afford. When you find a home you love, you put in an offer. Having a pre-approval increases the odds that your offer will be accepted because the seller will know that you're serious. In today's competitive market, that can be a big deal. If your offer is accepted, you'll need to submit additional paperwork to your mortgage professional so they can go through with the approval process and determine the final numbers. At this point, your real estate agent and your mortgage professional will guide you through the remaining steps, which will include things like an inspection, an appraisal, and a closing process. When all is said and done, you'll have your mortgage and you'll officially be a homeowner. In the end, it all comes down to preparation. If you prepare the right way, getting a mortgage and purchasing a home can be a simple, painless experience. But if you don't prepare, you're in for a drawn-out process filled with lengthy delays. I want to thank Matt Gouget for taking the time to have a conversation with me and answer my questions about mortgages. If you'd like to hear our entire conversation, check out the Practical Personal Finance podcast. It's available right now on Apple Podcasts and Spotify. And if you'd like to learn more from Matt, I highly recommend checking out his YouTube channel. It's called Matt the Mortgage Guy, and I'll leave a link down below. Are you saving up for a down payment on a home? How long until you're ready to buy? Let me know in the comments. If you enjoyed this video, click right here to learn about how much you can afford to spend on a home. And if you're not already a PPF subscriber, you're seriously missing out. Click right here to hop on board. Thanks for watching. I'm Andrew Scheer, and I'll see you next time.